Woohoo! Hello, hello, hello. We're going live for Market Mondays. Going live for Market Mondays. Um, Hi. It's April the 10th today, right after Easter weekend, getting ourselves all prepped and ready for another good week in the market. Yep, come on. As they say, come on in, come on in, come on in, get in here, get in here. I mean, wonder why people wait at the beginning for folks to start. I guess you got to give it time for it to catch, so people can see that you're on, can come on and join you. Yeah, yeah, yeah. Whew. Okay, so I do have some options, some options and opportunities that we're going to talk about for the market this week. One thing we're going to do is we're going to update the trades that we currently have going. We're going to update those. And we're also going to talk about put credit spreads. We've talked about covered calls. We've talked about cash secure puts. This week, we're going to talk about some put credit spreads. From a seasonality standpoint, the market is generally going up for the month of April. So we're going to look at some put credit spreads. If you don't know what those are, we're going to talk about it real quick and give some probable trade opportunities. Of course, I am not a trading expert. I'm none of those things. I'm not a financial nothing. I'm somebody who helps people learn how to trade the stock market, how to get some money out of the stock market. That's what I help people do. So, all this stuff is do at your own risk. I'm not trying to tell or convince anybody to do anything, just here to help you learn how to get some money out the market. That's what we do. On Market Mondays, we learn how to get money out of the market. That's what we do. Okay, so let me share my screen. Sharing my screen so that way we can, okay, there we go, present. Every week I go through this where I have to fight with myself on what to do. I'm sharing screen one at this point. Let's just do that. Okay, I'll take us to inside of our trading portfolio. I'm a fan of Thinkorswim. I think Thinkorswim is very robust. It is great for beginners. It is great for people who are intermediates. It is great for experts. Whatever you need, Thinkorswim will help you get there. If you're a basic user, Thinkorswim can work with you. If you're somebody who needs, who wants a little more, Thinkorswim can ride with you. If you're an expert and want things like, quick keys and I think it's called something trader. Anyway, it's called something where you can active trader. It's called active trader, where you can hop into trades really fast by pushing one button or two, and you're up and running. So Thinkorswim, TD Ameritrade has all of that. Let's look at what trades we had going already. We're going to enter some others because we have some ones for covered calls that we're ready to put on the covered call part. We have the shares we need to put on the covered call part. So let's do that first, and then we'll move into our covered calls. I mean, our put credit spreads. All right. Let's look at what we currently have. Our AI trade is expiring on April the 21st. We have a 27.28 put credit spread at this point, and it looks like it is breached at this point. Notice here it says this P&L open shows us a negative 50. Basic says we're $50 down 142%. And I don't know how that works. You can't lose any more than the width of this trade, right? You can't lose any more. When you're doing put credit spread, you can't lose any more than the $100 total. So it looks like we took in $35 to do this trade, and it's fully breached, so it's worth $100 at this point, or $95. And that's the most you can lose. But we've got 11 more days. We'll see what happens with that trade. It's a put credit spread. We'll come back to that most likely next week. We've got AMC. AMC, we bought 100 shares a few weeks ago. And we bought 100 shares at $4.40. Now AMC is at $5.22. That's where it closed today. So let's go and look at setting up. Let's look at what kind of covered call we want to do moving forward. We paid 440. So when you're doing a covered call, you want to make sure that you are doing a covered call over and above your trade price or your cost basis, it's called, right? So if we look at each week, AMC, we paid $4.40. So we want to get a strike price that's higher than $4.40. And at this point, you want to go higher than current price because you don't want to pick like $5 and it's unless you don't think it's going to stay above $5. And then it comes down, you end up selling your shares for $5 when you could have sold them for more. So you want to go above your cost basis and above current price. So above current price would put us at $5.50 or 5.5 strike. That means we would collect $14 in premiums if we were to do a covered call for this week. That means for this week only, it's going to expire on Friday. Let's just take a look though to see what kind of money we get if we go out one more week. If we go out to we go 5.5 and we go out to April 21st, we can take in $24. So we could take $14 if we go out this coming Friday. We can take in $24 if we go one more Friday. Let's just look for giggles. If we go to 5.5 3 weeks from now, actually 2 weeks from now, 18 days, we can collect $30. So we can double the amount of premiums we take in by just allowing our shares to be lent out. If you want to, we lend them out to the market for a covered call, we can take in $30. When you do these trades, the money you get for premiums, you get that money right away. Right? If we decide we're going to enter this trade at the 5.5 strike and take $30, we get this $30 right now. And we can spend it on something else right now. Right? So I like this one. I like the $15 that we can get in the very same week too. I do like that because it's short term. You're leveraging your strikes in a short period of time. Um, remember you got to pay a little bit in fees. It's like 65 cents per time, so that's not, and you pay a little bit more because the broker takes their money. But I think I want to go with a shorter time frame. I think I like that. I've talked myself into it. I usually go 1 week or 2 weeks. Unless there's going to be a whole significant difference in what you're going to get in premiums, you might as well go with short term. Might as well go with short term. Long as you go above your cost basis and above current price. So I'm going with the 5.5 strike for this coming Friday. We only have 100 shares. So that means we need to have only sell one covered call. 100 shares, one covered call, right? And I'm gonna change this to $15. You can change this limit price to whatever you want it to, if in case you want more in terms of premium. This is only going to go on as a good till cancel because the market is closed right now. So this is going to sit and wait for it to be picked up in the morning. Okay. So I'm going to do my confirm and send. That order is just sitting there for tomorrow. Okay. That's the AMC. Let's look at Fubo. Our Fubo trade we were doing for April 21st. We're doing a one put on Fubo, but we're up 67%, 66%. I close these about 50%. So we're going to close this one. We took in $12. Right? We took in $12 in premiums. It is currently only worth $4. This is good. As a seller, you want the premiums to go down. You want to receive one amount of money, and if you're going to have to buy it back, you want to buy it back for less. So I'm going to right click this and create a closing order. Tomorrow we're closing. It'll close tomorrow morning, hopefully, when the market opens. We received $12 for it. We're going to pay $4 to exit, and we keep the difference, which is our $8. We will do that. Okay, that's on Fubo. Fubo was an inexpensive one. We sold a cash secure put on Fubo last week. That's how we ended up with this. This was selling a put, and we sold a one put for the 21st of April. And because price has gone up just enough, it's moved us into profitableness. This trade only costs $100 of collateral. So if you're trading and you're thinking, I don't really have a lot of money to trade with, well, there's trades that cost $50, trades that, and I say cost, they really don't cost you anything. The broker reserves that money as collateral. The broker doesn't charge you anything when you're a seller, but the money for the trade or the collateral buying power is blocked off while the trade is going. That's how that goes. Okay. Let's check out our Silvergate. Silvergate, another bank. We have 100 shares of Silvergate. We paid $2 per share for Silvergate, but it is currently at $1.39. So our asset is upside down. We paid 200, but now it's worth 139. So we're $61 in the hole on the asset, right? So the shares now are worth $139 when we bought them for 200, so they've lost value. Since we own them, we can do two things. We can either sell the shares if you want to just get rid of them and accept your loss, or you can do a covered call on them, keeping in mind that you did a trade price of your cost basis is $2. Our cost basis is $2. So we need to get a strike that's at $2 or higher for our covered call. We're going to Silvergate. I'm going to look at what we have for the two strike. So this can be the danger you run into when you have shares and you're covering, right? We paid $2 for them. Well, currently, if we do for this week, there's no money in the premiums box for the bid, right? So we'd have to go out further. So let's look at the 21st. 21st, two strike. We have to go with the two strike because that's how much we paid for them. There's $5 there on the 21st of April. We go out another week to the 28th of April. There's now $10 we can take in for the two strike. That actually isn't too bad. Let's see. Now we're $60 in the hole though, so you got to keep that in mind. The two strike here still shows as $10. 1.5 strike has got some money, but we paid $2, so we need to have a covered call of at least two. All the twos going forward only have $10. Nobody's willing to pay more. Nobody wants to pay more. So let's look at the 28th. That was the first place we saw. Let's say, did the 21st have? No, that was $5. So the 28th is the first place where we have $10 as our premium for a two spread or a two strike. Sorry. So let's go ahead and put that on we might as well try to get a little something out of it in the meantime, since we have shares that we paid $2 per share for, and now it's lost its value. Again, we could just we could sell our 100 shares, take our $139 and be good with it. Just take our $60 loss. We can do that too. All right. It's definitely a personal choice of whether you want to release the money to go do something else with it. But when you sell the shares, you're also saying, I'm releasing, I'm locking in my loss. I have a $60 loss. I'm locking in that loss. As long as it's just in your portfolio, you have an unrealized loss because you haven't closed the trade. Let's look at Zim. For Zim, we have 100 shares that we bought. We bought 100 shares at $22 back just before they were going to pay out the huge dividends. We paid $22. Of course, people get their huge dividend and then they sell off because, they're like, why keep them? I'll just buy them again right before dividend day and take my money out of the pot and then buy them later. So we now have 100 shares that we need to cover call and we need to sell. So we paid 100 for 100 shares. We paid $2,200. Now there were 1,762 or $1,762. So we're down $438. But let's see what we can get in for covered calls. We need a 22 strike. We need a 22 strike because that's our cost basis. And you'll hear me repeating some of the same things because I want you to understand where I'm getting these numbers from. That I'm not just coming up with them out of the air, but I have a reason I'm saying these numbers. So 22 strike for this week has no premiums. 21st, the 22 strike has $2. $2. I'm jumping 2 weeks to the 5th of May. The 22 strike has $5. You see, this is not worth it for us at this point. Prices are going down. So We're $8 for 22 strike. So you have a couple of things. You can hold on to these 100 shares because you know it's going to pay a nice dividend in another 3 months. You already spent the money. You can just hold on to it, or you can sell it. Again, realize the $438 loss. Not necessarily something I like to do. So I usually I probably hold on longer than I should hold on at a lot of times because I'm like, oh, maybe it won't recover per se, but I just don't like locking in the losses. Sometimes we have to though, just so we can move on, lock in the loss and move on. Okay, let's talk about some put credit spreads. When you're doing put credit spreads, this is selling put credit spreads. This is not, when you buy a put, price is going down. When you're selling puts, you're expecting price to go up or at least stay up above your strike. When you're doing put credit spreads, you're selling at an option at one strike and you're buying an option below it as your insurance. It's a way for you to enter into selling puts much cheaper than if you were selling it outright and having to put the collateral for the entire thing on the line. If you do the put credit spreads, you only have the amount of collateral that's the width of the spread. So a one spread has a width of $100, two spread, $200, three spread, $300, right? That's what's going on with spreads. You sell at one price and you buy just below that when you're doing put credit spreads, right? So let's look at some of these that we could maybe look at for this week. Let's look at United Airlines. I'm showing the charts because when you're doing put credit spreads, you should check out what a chart shows you. Is it in the support area? We're talking about put credit spreads now. So you want to get below the support area or at or below the support area for your strike because you win these when as long as the price is above your sell strike at expiration, then you win these trades. Remember, you get your money on the front side, and then as the trade goes on and on and on, as long as price does not come down below your strike or it's not at your strike at expiration, you get to keep all your money. The premiums deteriorate, which is what you want them to do, and you get to keep all the money that you took in premiums. I again try to close my those trades at about 70%. Put credit spreads more like 70%. If they can go all the way in a short period of time, I'll take them down to more than that. But for the most part, if I can capture 70% of my premiums and keep it, then I'm good with that. So looking at United Airlines, you see that we're down here just above the support area. Just above the support area. Support here would be in the $42 range. I usually use the bottom of the box as my support area, not necessarily the wick. So 42 could be a good spot. So we could maybe look at 41, 42. Let's move to the option chain. I'm going to switch this to verticals. If we look for just this week, and we're looking at 41, 42. Notice for United, I keep saying Universal. For the United Airlines, it's a 50-cent spread, 41.5 and 42, which means you can enter these trades for $50 of collateral. $50 of collateral, you can enter these trades. So 41.5, 42, if we're looking at just this week, so for $50 of collateral, we're going to receive $12 in premium. So really, we're only putting out $38 in premium. How'd I get 38? $50 minus 12 gives you 38. All right. So you can say 42, 41.5, collect $12, leverage your $38 for the rest of the week because it's only for this week. I like that trade. I want to do a short term so we can see. I'm changing this to good till cancel because the market is closed right now. So I need to put it as good till canceled so that way I can see that it'll stay on. I don't have to go in the morning when the market opens. I don't have to go and make sure I put it on or whatever. Premium here, you can again adjust this number if you want to put, maybe make it a little bit higher. It's only going to pick up that trade if the value of the spread is worth that. If it's not worth that, it won't pick it up. So sometimes I will put higher than what I'm actually looking for, just so it'll keep it in the working pile. That way I can see when the market opens, I can then see where it actually is. Okay, so I'm putting 15 there. So again, the collateral for this trade is $50 minus the $15 you're taking in premiums. So the collateral is only $35. And we're doing it for 1 week. Now you could go out further in time, right? Let's look real quick at what we would have taken in had we looked at the 21st. If we want 41 and a half, 42, you got $14 instead of, it was 12 there. If you go out 2 weeks, same strike prices. Now there's no 50 cent in here. It's a dollar spread or one spread, and you're going to collect $28 in premium, which means you're leveraging $72. You're leveraging $72 if you do that, right? UAL, that's what we did on that one. Let's look at something in the coin, in the crypto space. And I say crypto from the standpoint of it's a part of the stock that goes with crypto. It's not a crypto stock per se. You got Riot, Mara, Coin. Now, what you want to keep about those, they all actually can fall into the criteria of they're going up. But you may not want to do all of your trades in one little sector. If you got Mara, Riot, and Coin, you may not want to trade all three of those the same week, because if it works out great, then it's great. But if it doesn't work out great, you're basically triple leveraged or whatever in an area that could all go down together. So you kind of want to spread, be diverse in your pickings. I'm picking Riot. Let's look at the chart before we do anything. We can see here that Riot has gone out of a support area actually. Well, it went out big time. This is the support area, would be down here. $8.98, let's say $9. It's currently at $10.50. It looks like it's huge, right? Because it's got this big old candle, but it's $1. $1.50. So 10.58. So let's look at what the 9 strike has to offer. This is the support area. Let me put a line here so you can see what I'm talking about when I talk about the support area. Support area is here. Let me find I need to plug in my computer because it's going live takes the battery juice down really fast. Okay. So the support here would be like $8.96 or $9. Let's go look and see what $9 has as far as strikes go. If we're looking at 9, another one, the Riot also has 50-cent spreads. So again, you could leverage less than $50 on these trades, right? So from 8.5 to 9 for this week, there's only $2 there. So I don't think that's worth it for this week. Go out a little bit further, 8.5, 8.5 to 9 is a $7. And that's because we're 10.58 is we're a little bit further away from the price and it's going up, right? So anytime price is moving away from the strikes you're picking, then the premiums are deteriorating. Premiums are not going to be as nice. Okay. If we go with 8.59, which is a $50 of collateral, but we're taking in almost 10. I mean, that's a 20% return on your collateral. Not too bad, right? 20% out of the $50 that you're leveraging, you're taking in 10, so you're basically only leveraging 40. That's about a 10%, 5%. No, sorry. My brain just did its own thing. So 20% return on your money, 20% return. So I'm going to stick with April 28th on that. I'm going to do 8.59. Now, what you can do too, if you want, actually it's $12. If you wanted to widen the spread, maybe you wanted to do $100 spread, you can change the 8.5 to 8. That makes this a one spread. So it makes it $100 of collateral. You're only collecting 20. Again, that's still 20% return on your leveraged capital. Not a bad situation to take in 20% of your money in a week or 2 weeks of time to get a 20% return. Not bad at all. I'm also changing this to 15 just so I can watch it in the morning when it opens up. Change this to good till cancel. I'm doing 8.5 to 9, which is a 50-cent spread, $50. We're collecting $15 though, which means we're only leveraging $35 on this trade. The further out you go in time, the greater you're going to take in premiums. Keep that in mind. When you're doing it shorter, the premiums may be smaller. You go out in time, you're losing the same, you're leveraging the same money, but you're collecting more of your premiums back on the front side, which, that's a good thing too, right? So we did, what did we do? We did Riot and we did UAL, keeping it different thing. I'm gonna two more. I'm gonna show you. How about First Solar, FSLR? FSLR. We're showing that one next. Anybody got any questions or comments? If you do, please put them into one of these chats so I can see them. Okay, so I wonder if, oh, do I need to move this over there so I can see what's happening? What's going on? I need to be able to see what's going on. All right. There we are. So let's look at, this is First Solar. First Solar. Let's go look at the chart first. Check out our charts. Oh, First Solar looks like it's between two tight zones. If you're looking at charting First Solar, let's look at putting some lines on here. We've got a support area, which we've just left at 201. 201, between 200 and 201. And above us here, we got a pretty strong resistance area. I don't think I'm going to talk about iron condors on this call right now, but iron condors is when you sell a put credit spread and you sell a call credit spread at the same time. And your thought is that price will stay between these two zones. Turns out price has been between these two zones for several days since back at the early part of March. It stayed between these two zones, right? This is maybe a good opportunity for an iron condor. Might be a good iron condor opportunity. All right, let's go look and see what the Mondays looks like. Let's go see what the money looks like. We want to get below 200, right? Let's get below 200, and we can look above the 220 and see what that gives us. Let's look below 200. I'm looking at just this week. For now, I start there and then I go out further, depending on what's going on. Now, the difference here, notice that the one with the 200 is 197.5, 200. This is a 2.5 strike. 2.5 spread. Sorry, not strike. 2.5 spread. 2.5 means you're leveraging $250 because you need to multiply times 100. $250. So, do you want to take in $9 if you're leveraging 250? I say no. Probably because 200, current price is 212. So we're about $12 above what what we're looking at for call credit spreads. So 197.5, 200. If you go out a couple of weeks, you can collect $40. You leverage 250 and collect 40. That's almost 20% return on your money. If you go out just a little bit further, let's look at May the 5th. May the 5th, you get $35. That was weird. Why was the other one? Oh, it says here when you click it, it pops up and says $70. $70. Let's see what it does when you click on it on there. Oh, it's saying 75 there too. Wonder if it's acting wonky because the market's closed. Let's see what this one does. Oh, I thought no, it changes. Okay, so we can look at April the 28th, which is a couple of weeks. The 197.5 200 put credit spread brings in $75. You leverage 250, you collect 75. Sounds good to me, right? Sounds good to me. 250, 75, that's a 30% return. Yep, 30% return on your money. Well, I wonder if I change those other ones down from 10. I didn't want us to do 10. I didn't want us to do 10, 10 contracts. I only want us to do one. One contract. We've got First Solar, 197.5, 200 put credit spread, leveraging $250, but collecting 75 in collateral. So you're really only leveraging 175, right? I'm going to go ahead and do a good till cancel. We'll put it on for tomorrow when the market opens. See how we go with that. We could look at, what did we say for the iron condor? I think I said that we could also look above 220. Look above 220, 220, 22.5. Now, the good thing about iron condors, we'll talk about this a little more in a subsequent video. When you do an iron condor, you don't leverage any more collateral. So if we already leveraged the 175 on the other side, we don't have to put any more collateral into this trade. We're only doing one side or the other because the broker knows price can't be in two places at once. Either it's down here or it's up there. It's not in both places. So if you have two trades going at the same time, one up here, one down here, and price ends here at the top, let's say, then this trade automatically wins because price can't be in more than one place at a time. 220, 222.5 would be where we would look at. Actually, we're probably going to get better premiums there because price is going up. And when price is going up, you get better premiums when price is moving towards your strike. When price is moving towards your strike, you get better prices. Okay, let's do one last one. And the last one is a very popular one, Google. Very popular one would be Google. Oh, come on, let's get us a chart to look at. Looking at a chart. See what our support is. Google support is going to be down in here. 104 something, 105. If I change this style from candles to a line chart, change it to a line chart, we can see that right here in this, where this dip is, there is a place where price takes a pause or takes a dip. This would be a support area right here, right there. And then we have some resistance just above it too, where price went right there. Wait, where did it go away? I need that to stay here. There we go. Take it off and change it to the finger. This is where our support is in the 104.5 and our resistance at 108.42 may provide another opportunity for an iron condor. Let's look at the candles. Support is right here in the 104.51 and resistance 108. That's kind of close. That's a little close for me for, Google. You see how it almost ran the whole distance of the support to resistance all in one day. And if it's going up, I probably would go with looking at the support. So let's look at 104, maybe 103, 104. Google is another one that has one spread. We've talked about 5 spreads. We've talked about 1 spreads. Google has, we talked about 2.5 spread. We didn't talk about any 5 spreads. We talked about 50 cent. 50 cent spreads, 1 spread, 2.5 spread. Now here we got a 1 spread on Google, and I talked about 104. So 103, 104. $100 of collateral minus your premium that you take in of $18 means you're going to leverage about $82 at 104. But if we go out a little further, maybe we'll get better money at the same strike price. 104, not sure why that one says 5 cents. 33. $33 Google put credit spread 103, 104 going out 2 weeks. Going out 2 weeks. You look at your support, you go below the support for a put credit spread, and then that your belief is that it will go up and or stay up at least above through the expiration of your trade. 2 weeks is what we're putting on here. And you're going to collect $33 right away when this trade picks up. I'm taking this up to $35. I like good round numbers. Good round numbers. Confirm and send. I made sure to put good till canceled so that way we can see, tomorrow morning when the market opens, we'll be able to see where they are. Let's see what we put on. Let's go do a quick review of what we've set up, right? We set up some AMC covered call. We had AMC 100 shares. We set up a covered call for that for the morning. Fubo, we also had 100 shares. Oh no, Fubo was the one we were going to close. See, notice how this is green? The green means that we're buying it. We're buying something. We're buying it back. We're going to close that cash secure put there. For the SI or Silvergate, we're going to open a covered call with Silvergate. And then we set up 5 different put credit spreads where we've said, okay, we've got United Airlines, Riot, First Solar. I went ahead and put in both sides for the Iron Condor and Google, right? And Google. So let's look at how much money we're looking to, how much money are we going to have to leverage to do these trades? So for the United Airlines, we're 50 cents of collateral, $50. For Riot, another $50. So we're talking about $100 here. For the First Solar, $250. So we're talking about $350. And then remember, we're using the same collateral for both of these First Solar, so we don't have to count that twice. So we're at $350. Another $100 for this Google puts us at $450. We're collecting, so we're using collateral or buying power of $450. And we're going to collect 33. Well, actually, we're collecting, I'm putting my price over here, $35.87. So it's $120 plus 75 more, $195, $210, $225. And then we're collecting $25. So about $250. So we're putting out $450 and collecting back $250. We're leveraging $450 and collecting $250. So we're getting half of our money back as soon as we enter these trades. So we're really only leveraging $250. Not bad, right? You're going to enter several trades, right? You're going to leverage $250 total on several trades. All right. Just so I don't forget, we are having, where's my digger? There we go. We're doing Wednesday and Thursday of this week. We're going to have I'm going to stop sharing. We're going to have the Options 411 2 days boot camp where we're going to introduce beginning traders. The things I'm talking about now, all this stuff is learned inside that boot camp, inside of our 4-week. It's what we're getting here. So if you don't know what I'm talking about, but you're kind of interested, you can come on to the boot camp. It's $27. Come to the boot camp, check it out, see what I'm talking about. I am an educator, so my job is to, teach people concepts that can be confusing to some, but to make it a little bit clearer. So I break it down into a way that is easier to understand. We include everything from what broker you should get in on. How do you set up your brokerage account so that you can operate as a seller? What are the strategies that we use as sellers, and how do you use them? How do we practice them? We practice together, we push our buttons together, and then when it's all over, we have graduation. So head over to http://educatortotrader.com. You can get registered and join me on Wednesday and Thursday of this week. All right, I believe I have done all that I was going to do today. I have said I was going all I was going to say today. I want to bid you all a fond farewell. If you're watching me on YouTube, please like and subscribe to the channel. I'm growing the channel. Of course, everybody's growing their YouTube channels. I'm trying to grow mine too. Join the channel. This is the kind of stuff I put out, content I put out on a regular basis. And I'd love to have you to join us on the channel. All right. I will see you all soon. Bye. Bye. Bye.